Good morning and happy Monday, and welcome back to another edition of Accessible Alpha's Market Update for the week beginning September 9th. What a week it was last week in the markets. But before we get into that, my name is David Baines. I am the principal of Pantile Investments, which is a registered investment advisory business. Please keep in mind that anything we discuss in the Accessible Alpha market updates should only be construed as informational purposes, educational purposes only. So please don't construe this as investment advice. Do your own research. Hopefully what we talk about here can help, and you can start to think about trading or investing in maybe a more, knowledgeable manner. But please don't take anything that we discuss here as an investment advice. So let's get into it. Market news, a lot to cover. The last week was basically a whole lot of nothing. The big kind of news out of last week that there just wasn't a lot of volume. There wasn't a lot of buys, there weren't a lot of sells. And if there were, they kind of counteracted each other in the indices, and we didn't really see a lot going on as folks really wait and see of what's going to happen with maybe interest rates or economic data. This week was pretty dissimilar in the sense that, especially punctuated by the sell-off we saw at the end of the week, I think markets are starting to make a bit of a decision. So I personally love this meme, but I feel like most traders, have their system. Specifically, traders in bullish markets, long-only traders have this system. And then when markets start to go a little sideways, which we've clearly seen in the past bunch of weeks, really going back to mid-July, they say, hey, everything's fine. Things are going up and down, and we're seeing some rotations and volume's a little light, but everything is fine. Everything is not fine. That's my take on it anyway. So for those on the podcast, this is the theme of the dog that's in the middle of the home. The home's on fire, and he's basically looking, saying, "Hey, everything is fine." And like I said, I don't think everything is fine. So from September 17th to 18th, the FOMC is going to get together, have their meeting. We think that there's going to be a rate cut. But before all of that even happens, personally, I'm continuing to trim positions. There's a quote that we'll get to at the end of the show, but it's from basically the beginning of the 20th century. Jesse Livermore was an infamous trader, and he had this quote that says, "There isn't the bull side and the bear side of the market. There's just the right side." And right now, I don't know what the right side is. It seems like we're kind of at this top. There's not a lot of activity. Maybe we need the FOMC to come out on the 17th and 18th, officially announce this cut. Maybe that'll get things moving into a more bullish direction. But honestly, we just don't know what's going to happen right now. So speaking of rate cuts, let's talk about that a little bit. So this is, courtesy of CME's FedWatch, and this is basically what is the probability of seeing one of these two rate cuts in the market. Basically, how this is calculated, if you're not familiar, is it's taking a look at about 30-day forward rates, comparing that against the rates, the actual FOMC rates that are in the market right now, and the delta between those two is basically how the market is pricing in what they think the rate cut is going to be. So right now, about 70%, there's a 70% probability that we're going to see a 25 BIP rate cut, which is going to bring us to about 5% to 5.25%. But there's still a 30% chance that we could see maybe a bit more, a 50 BIP rate cut from 4.75 to around 5%. And you'll see that, that's the rates as of today, or the probabilities as of today. Going back, 1 day, 1 week, they were the same. But going back to 1 month, we weren't really sure. Maybe we need that Jerome Powell speech in Jackson Hole to really solidify, how markets felt about it. But as of right now, we're looking at about 70% probability that there's going to be a 25 BIP rate cut after this FOMC meeting from September 17th to the 18th. So I also thought it would be kind of interesting just to do a general overview of where we are right now. Current unemployment right now is kind of stuck at 4.2. This is not too bad, quite frankly. I mean, this is off of the low of right before COVID, February 2020, of 3.2%. Last year's lows, or last year at this time was 3.8%. But keep in mind, the long-term average for unemployment is 5.7%. So when we think about what the Fed has responsibility for, it's only two things. It's to keep inflation around that 2% annual target, and it's to keep unemployment as low as possible. There isn't a specific number they have in mind, but they want to keep it, basically as low as possible. So, from an economic standpoint, things are looking okay on the labor front. Non-farm payroll was released last week. We saw jobs that were added in construction and healthcare, which again is a good sign. And inflation is coming down. Core PCE is about 2.6 for July. Kind of non-core or just regular PCE is 2.8. Keeping in mind core PCE basically means that the index minus food and energy. So what folks are spending money on minus food and energy. PCE obviously includes food and energy, and then the CPI is at 2.9. And then just quick note here, PCE, the difference between PCE and CPI I think is important to note. CPI only looks at urban areas, and PCE looks at rural areas as well. So just something to keep in mind there. Those numbers should be relatively similar, but the Fed actually uses the PCE as their kind of go-to benchmark for inflation. The other thing that may be interesting, the FOMC will release its what they call a dot plot, which will actually show the guesses from the different presidents of the different Federal Reserve banks, their kind of guesses for future rate cuts. Again, this could completely change. We went into 2024 thinking there would be 6, 7 rate cuts. We haven't had one yet. Maybe we'll get one in September. But it is interesting to kind of get into their minds and think about how they're interpreting the economic data that's coming out, and what that could mean for markets moving forward. So I thought it'd be kind of interesting to do basically just kind of look at the past, right? So in this week, when we look at the indices, there's really two things we're going to look at here. The first is when we look at the indices right now, obviously we saw some pretty significant sell-offs, one on Tuesday, one on Friday, and we really saw that across the board. When I'm looking at indices and really trying to determine market direction, first thing is, are the indices aligned? Are they moving in the same direction to relatively the same proportion? The answer is yes. The one caveat here is, as I've pointed out in previous weeks, the S&P, for example, kind of got to this high, maybe around mid-July. We saw that sell-off. Then a quick rally back, and we actually saw that not only in the S&P, but we saw that in the Dow as well. But you'll notice that the NASDAQ, which is on the bottom left if you're on the YouTube video, is still lagging behind. And that basically indicates that, yes, there is this rally, but as I'll point out here, the rally didn't see pretty significant volume. And we saw that in basically all the indices. It was a little healthier in the S&P, and certainly less healthy on the NASDAQ. But basically what this indicates is that, tech is out of favor. We've made our profits in 24, and certainly in 23. It seems like big institutions are rotating out of technology, and we should be really cognizant of that. As any market participant, you want to be extremely cognizant of what's in vogue and what isn't. But going back to the indices, it seems like they're at least aligned, which is a good thing, because if we do enter, a bear market, and who knows, we just need more data to basically come out, and I think this week was a little indicative of what the market feels. But we need them to be aligned, we need them to be converged, and so far so good. So let's look at history. So last week I spoke about when the first rate cut happened, in the sense of easing over some time period. What happened? What was kind of the forward return, the 12-month forward return in the market? There's a bunch here, but I actually pointed these 4 periods out: October 84, June 89, July 95, and July of 2019. And the reason why is that, well, first of all, we weren't in kind of a recession land, and we're not in a recession land now. So in those 4 periods, the period that we're in now, we're seeing positive GDP growth. we're not really in a recession. And the others is, real GDP growth was kind of in line, again, positive. Inflation was, we're relatively in line with where those 4 periods were. And the same is true with unemployment rate. Obviously, in October of 84, much higher at 7.4%, kind of coming down in 89 and 95 at 5.2 and 5.7% respectively. But, at 4.2% today, I took the slide from the data from last week. But at 4.2 today, these 4 periods seem to align with where we are now. So I thought it'd be kind of interesting just to look at what happened with the market. This says it on the slide, what the 12-month forward return, but what actually happened in the market. So this is going to be the S&P 500 across these periods. And I think it's really interesting to look at because you may think, all right, well, when rates come down, it's already priced into the market in a sense, but when that official announcement comes out, and we already have some relatively strong economic data as a backdrop, maybe equities will just take off. So this is the first one. This is in 1989. June 7th is when the market or when the Fed released its announcement to drop rates. And basically what happened is, we're coming out of still inflation, out of the 70s, early 80s. And basically what happens here is that this is going to be a long run of rate cuts, really going all the way to 1992, where the Fed funds rate at this time was about 8%, got it down to around 3% eventually in September of 92. But we're coming off of high inflation, and basically what we see is that once they cut that rate, it took a while to kind of take hold, but we're also coming off a bull run as well. Leading up to this, yes, inflation was high and coming down, but there still was this kind of bullish activity, which we've actually seen kind of late last year and certainly in 24 as well. So it wasn't like the rate was cut and all of a sudden, markets took off. You can see it took, a month or two to really grab hold, and even then we weren't totally out of the woods. Once we hit October, November, things get things kind of go back down. So I think this is a good lesson from history where, yes, rates coming down are a good thing. It allows banks to lend a little bit more. It allows companies to borrow a little bit more, which should increase jobs and earnings and things like that. But it's not this, it happens, that the Fed drops the rate and all of a sudden we see this giant bull run. So, so that was in June of 1989. Let's go to 1995. This was on July 6th. Again, now we're coming off of the savings and loan crisis from the late 80s and early 90s. And basically, the Fed announced their decision to drop the rate. They were looking at an employment rate of around 5.6% at the time, so a little higher than ours. But as you can see, a pretty nice little bull run, in 1995 leading up to this. Obviously, technology is starting to really take off. We're not quite to the bubble, the 2000s yet, but the 90s saw a lot of kind of consistent bull run activity with technology companies coming to the fore in the economy. But as you can see, as they cut that rate, kind of a whole lot of nothing happened. It basically, as the Fed described in their release, they just wanted to, provide a little bit more stimulus because retail sales were weakening a little bit. But for the most part, things were looking fairly healthy in the economy, barring what was happening with the kind of tail end of savings and loan. And then the last one is in 2019, so much more recent history here. And basically the same is true here. We had this bit of a bull run. If you remember, we had that giant sell-off at the end of 2018. But in 2019, we had this nice little bull run, bit of a sell-off in May. But then when the Fed dropped the rate, the market actually went down, which is really interesting. So, as Jerome Powell at the time kind of explained, this was just a mid-cycle adjustment. There was this kind of tariff trade war happening with China at the time. But the idea is that, inflation was far below the 2% target. Core PCE was looking great at around 1.7%. Jerome Powell would just kind of want to do this mid-market kind of checkup and make sure things could kind of keep on keeping on. But you actually see it didn't really affect the market that much. And maybe because the interest rate cut, things were going so well, it didn't really have an impact on how investors were thinking thinking about the markets. But anyway, I think it's important to look at this kind of thing. And you yourself, can go back in the charts, take a look at what happened at these major economic events, and what, why that mattered, or what happened to markets, what happened to your stocks that you like, what happened to your industries that you really like. This sort of analysis is simple to do, but it can actually be really informative. All right, so for winners and losers, quite a few losers last week, but I will point out there were a few winners as well. So the first I'll bring up is AT&T. They were up 5.4% last week, which I actually think is really interesting. Yes, they're in telecom, but we can kind of think about them as a technology company, right? What you'll notice here, I put in this yellow line here that in basically the end of June, without earnings or anything like that, they broke their high, at the time of, looks like, around, I don't know, the mid 18s, maybe $19, something like that. They broke that high. They broke that high with volume, and then they saw that little bull run, take off, which gets them to about $21 today. Last week, like I said, at 5.4% increase. We're also seeing that volume come back again. Again, not really enough for me to think that there's going to be this huge buying activity, but I've learned a long time ago, you don't argue with the market. You just try to pay attention, observe it, understand. So good for AT&T here. United Airlines, also had a pretty good week at 4.5% up last week. It's almost the opposite of what's happening with AT&T though. The first thing is they are far off their highs of pre-COVID levels at around $90. The volume is certainly not there. So we're seeing this rally come back from, the sell-off in August, but I put that little question mark there because this volume, through this rally seems really weak. It means not a lot of people are in there. And when you don't have a lot of volume, specifically on the buy side, I'm always a bit wary of what that means for prices and how long they can hold. So for example, you did see that when they announced earnings at the end of April, we did see a large spike in volume, but it fell apart pretty quickly. So yep, they did great last week. I'll certainly give them kudos for that. I don't know how long that's going to last though. And then the last one is actually Campbell's Soup. Campbell's Soup, again, I wanted to point out, very similar to the chart for AT&T. They broke this high. And they broke that high with some volume really in the beginning of August, which is kind of interesting because you remember beginning of August is when we had this big sell-off. Campbell's Soup didn't really see that. So good for them. From a fundamental standpoint, they're a pretty strong company. And it seems like folks are kind of getting into them more and more, as we can see by the volume here. Again, I'm not really personally going to rush out and buy Campbell's Soup, but it is good to know that there are some stocks out there that you can pay attention to and look for if you're looking for buys. I probably wouldn't load up too heavily on them, unfortunately, but it seems like there are at least some stocks that are doing well. For losers, there were a bunch. I'm going to hit three of the highlights. Zscaler was one of them. Last week, they were down 21.6%. And again, these are things that I pay attention to because they beat on earnings. I mean, they beat their, from a revenue, for an EPS perspective, the surprise was 25%. From a revenue perspective, the surprise was 4.5%. And they gapped down after earnings on the sell-off. And again, I'm not saying, buy or sell Zscaler, but what I am saying is that you can look at these things. If you have a company that's relatively healthy, and they're gapping down after beating on earnings. Again, we saw this with NVIDIA, we saw this with Target the past couple weeks. It can really be indicative of where folks are thinking about, what folks are thinking about the market. Broadcom, again, I said last week, I was anticipating what earnings would do here. Again, speaking about what I just spoke about, where if Broadcom does really well, and they did, they surprised on EPS by about 2%. They surprised on revenue by 72 bips, so nothing crazy there. But again, gap down. So it seems like this company is extremely healthy. We see this weekly chart on the bottom. I mean, they were down almost 16% last week. And again, just leads me to believe that folks are taking their profit and moving on to maybe more defensive things. The last one is our darling NVIDIA. Got to keep up with these things. I haven't been long in NVIDIA for a long time, and I hope the same is true for all of you. But NVIDIA was down almost 14% last week. But it was the largest one-day market cap drop for a U.S. stock in history. I think it was something like $270 billion, which is unbelievable. But again, goes to show that, yep, the company is fundamentally doing well. We saw that last week when they announced earnings, but folks are rotating out. It just seems like, they're selling off, they're taking their profits. These are things to really pay attention to when you think about, working to understand how the market is going. Is it sideways? Is it going up? Is it going down? When the past leaders are selling off like we're seeing today, or seeing lately, that can be really indicative of what's going on. I didn't make slides for these guys, but there's even talk of Intel basically dropping out of the Dow Jones. So there's a lot of rotation going on right now. These are things to think about and pay attention to when you think about what's happening with markets. All right, speaking of industry rotations, again, a lot of red. The S&P was down, 3.6 for last week. But as I've said, in weeks past, and I'll always say, to get a good idea for what's in vogue and what's not, you can cheat. You can look at State Street's what they call the sector spiders, and these are the ETFs that are comprised of the different sectors of the S&P. The highlight of the week was consumer staples. Their 1 week performance was a little over 1% gain. Clearly, technology was the laggard here at losing over, 7.2% last week. But it's still interesting, as you look at these things week over week, or maybe even day over day, if you want to get a little bit more granular. But you can see, what's going up, what's going down, what's in vogue, what are people rotating into, what are people rotating out of, and then you can think about your particular holdings, your particular stocks. And the reason why that's important is that if you have a great stock and not a great industry, something that's rotating out, it may be going up now, but it's tough to say how resilient that momentum can be. So for the spiders, a lot of red. I guess, congrats to the more defensive, staples and real estate and utilities. We've seen that trend over the past bunch of weeks where, technology, energy, and telecommunications is getting hammered. So again, back to AT&T, great, great for AT&T, up almost 5.5% last week, but we're seeing telecommunications get hammered, and that leads me to believe that trend with AT&T may not continue, but who knows? I work to not predict the market, but just to understand it. In terms of more granular industry rotations, for folks on the podcast, I'll just read the slide, but industries that are continuing to move up, medical equipment and service, oil and gas, local banks, mining, integrated systems, tobacco and food. Tobacco and food actually rose again from the update last week, but ones that are new this week that I noticed that were just kind of jumping off the page for outperforming the rest of the industries, packaging, and then no surprise, REITs and real estate development and operations companies. Again, if especially if interest rates are going to come down, usually we'll see real estate start to do better and better. For industries that are moving down, again, for those in the podcast, I'll read the slide. We're continuing to see computer hardware, transportation, semiconductors, restaurants, electrical power equipment companies, steel and manufacturing coming down. And ones I've added this week that are moving down, underperforming the other industries, hotels, apparel manufacturing, and design software. And there are a few other software companies or a few other software kind of sub-industries in there as well, but design software jumped off the page. So again, when you think about stocks you really like, make sure the industry is in vogue. And if a stock is going up and maybe the industry is not, I always personally look at that as, well, maybe, that price movement may not be resilient as we'd like it to be. Moving on to next week, economic news. Consumer credit comes out. I think that's actually really interesting. If prices are really high and earnings are really high, but, wages are kind of staying the way that they are, that leads me to believe that everyone's putting their purchases on credit cards. And I'm paying attention to that because, when we saw with, 2007, 2008 with, mortgages, credit can drive, some pretty bad things if it goes astray. Not that we're anything close to that, but I do think the consumer credit reports are really interesting for items like that. Consumer price index, CPI is going to come out. Obviously, we're really working to pay attention to that because that can drive, how we feel about the overall health of the economy and folks' kind of willingness to spend money. And then the PPI, the producer price index will come out. Again, this is, if you haven't heard of this before, the PPI is very similar to the CPI, just from the producer's perspective. So what are they seeing with prices? Obviously, the consumer price index and the producer price index are usually pretty linked. But the difference between the two can be things like taxes or rebates or promotions, things like that. And then the import price index comes out on Friday. Again, this is kind of interesting because we get to see how well is the U.S. Working with prices abroad. How expensive are things elsewhere, maybe relative to what they are here. We also have the export price index that will come out, but the import price index will be coming out next week. For earnings and market news, there's not a whole lot happening, to be honest. Oracle, I did want to highlight because they are a pretty healthy company. But they've been sold off a lot lately. Obviously, they're in a kind of an out of vogue industry, but it's a really good chart right now, almost at highs. Really healthy company. Again, bad industry group, but we'll see what happens. Apple is not announcing earnings on Monday, but every time they announce the new iPhone, they could be talking about AI, new technologies. It'll be interesting to see what happens with Apple's price. So we always see kind of something happen with that. That's more just interesting than it is, maybe go pick up Apple. But always good to know. And the last one I wanted to highlight was Adobe on Thursday. And again, Adobe is one of those companies that is extremely healthy, has a really good chart, a really good earnings trend, but again, bad industry group. So I put these two in yellow. It's more just let's pay attention. With things like Broadcom that we've seen, certainly NVIDIA, when they go to announce and then they gap down, or something like that, basically just leads me to believe that the market is saying, hey, congratulations, it's great that the company's still growing the way that it should. We're just not in on it right now. Maybe we're going to rotate to more defensive holdings. So that's what's up for next week. Quote of the week is one of my favorites, but it really pertains to kind of what we're seeing, lately in these kind of sideways markets, I'll call them. Jesse Livermore was a trader literally in the early 1900s. I'm actually reading not his book, but a book about him called Reminiscences of a Stock Trader by Edwin Lefebvre. And he has this quote that there's only one side of the market. There's no bull side, there's no bear side, there's just the right side. And really what I interpret there is know where you are in the market. If you're a long-only trader, especially if you're a long-only trader, you got to know if the market's going up, going down. And you can't look at it kind of on any individual day because like we saw last week, it goes up and down. And then we saw this week, it can go down with quite a significant amount of volume. Know where you are. And if you don't know where you are, I think it's always, a pragmatic advice to just, get out. There's no shame in kind of sitting on the sidelines and waiting for things to correct, waiting for confirmation, waiting for maybe even more economic data is required. Maybe this Fed rate cut will help. But, there's no shame in just kind of waiting and getting back in when things are more healthy and efficient and kind of churning the way they're supposed to. But then on the other side, if you are, a short seller, wait until we're in a clear bear trend. Again, it's pretty far away from that. We'd have to dip below the 200 moving average or something. But wait, we don't have to make any decisions right now. I'm certainly not, and you don't have to either. So, that's it for this week. As always, please remember to, comment on the video, what you like, what you don't like, what can I do better, what other information would be helpful to hear. I've just started doing this, but I would like some feedback if you don't mind. It really would help, make the market updates hopefully better. So please do that. Please join our Discord. If you haven't heard of Discord before, it's basically an application on your computer, on your phone. It's a website as well. You can come into our community and just chat with us, ask questions. We can just talk about whatever. We talk about markets, we talk about trading strategies, we talk about technology that we use as traders, we talk about data that we use, we talk about books we really enjoy. The idea with Accessible Alpha is to make you a better trader, make you a better investor, a more knowledgeable and aware market participant. So come on in, it's free, we'd love to have you. Please like the video on YouTube, subscribe to our channel. These come out every Monday morning. And if you subscribe to the channel, you'll be able to get them kind of automatically. And obviously liking the video really helps as well. And then if you're on the podcast, rate the podcast, because again, it just helps. It can kind of push it up in the algorithms for recommendations. And the podcast is available on Spotify and Apple if you don't have time to sit in front of the computer and watch the video. So, that's it for this week. Who knows what we'll see this week, or next week, I should say. But it should be really interesting. So good luck out there. I hope the market treats you well. But if it doesn't, like I said, there's never it's never a bad idea to just kind of get on the sidelines, wait and see, get some confirmation, and you can save a lot of money doing that. So thanks for watching, and I'll see you soon.